Price bounces hard, but it does not escape the old box. The session forms inside expanded memory. Before any trade, the higher time frame comes first. Do not enter the 1-hour chart blind. Look at the monthly chart. Look at the weekly chart. Look at the daily chart. Especially the weekly chart. The weekly chart must stay in your head before the first entry line appears. The market is still near major pressure. April 1st weekly basis box lower boundary. March 1st weekly basis box lower boundary. February 1st weekly basis box lower boundary. Weekly 0.33. Weekly 0.25. February 5th key low. The falling trend line. The rising trend line. Those levels are not background. They are the field. When price moves near those areas, a 1-hour candle can look strong and still fail. A bounce can look clean and still stay trapped. A short can look late and still work. So the 1-hour chart must be read through the higher time frame field. Now look at June 7th Asia session. June 7th Asia session forms with expansion. It expands about 150% compared with the June 4th US session box. It overlaps with that memory. That matters. A wide basis box changes the trade. A narrow box can create tight pressure. A wide box can create wider reaction. The support and resistance do not sit in one tight place. They spread out. Price can move inside the box and still not choose a clean direction. That is the first warning. June 7th Asia session continues inside its own basis box. But more accurately, price continues inside the June 4th US session box. That is important. The visible Asia structure expands, but the real working memory stays tied to June 4th US. Price does not create new freedom. It rotates inside old memory. That changes the trade. You do not chase the middle of the box. You wait for the old boundary. Now we build the trade in the correct order. Stop line first. Entry line second. Target line third. Most traders start with entry. They see price rising. They want to buy. But if the stop cannot be placed correctly, the trade already fails. If the target does not pay enough, the entry does not deserve action. So the trade starts with risk. June 7th Asia session long. Entry line. June 4th US session lower boundary. Stop loss line. June 5th US session midpoint. Take profit line. June 4th US session upper boundary. Risk-reward ratio 1.79. The entry sits at June 4th US session lower boundary. Why there? Because price is not trading a fresh open range. It is rotating inside June 4th US memory. The lower boundary is where buyers must prove control. If price reaches that old lower boundary and cannot hold, the long has no base. If price reaches it, reacts, and stays above it, the long can form. The entry is not chasing the bounce. The entry waits for the lower memory to hold. That matters. A bounce in the middle gives poor control. A bounce from the lower boundary gives a line. You can define the trade. You can define the failure. You can define the target. Price reaches the lower side. It reacts. It holds. Then the long becomes active. The stop sits at June 5th US session midpoint. That stop is not random. The long is built from June 4th US lower memory. But if price loses the June 5th US midpoint, the recovery has returned too deeply into lower pressure. The bounce is damaged. The long no longer has clean control. So the stop sits where the idea breaks. Not where it feels comfortable. Not where the candle looks pretty. Where the trade loses its reason. If price reaches that stop, the long is not the same trade anymore. Leave. No hope. No argument. No waiting for another candle. The target sits at June 4th US session upper boundary. Why there? Because price is moving inside June 4th US memory. If the lower boundary holds, the upper boundary becomes the clean return target. The goal is not unlimited upside. The goal is the opposite side of the working box. That is why the target is not far above the market. It is where price has a reason to react. Price moves toward the upper side. The target pays if the range completes. Risk-reward ratio is 1.79. That is acceptable but not perfect. So the execution must be clean. If entry is late, the ratio weakens. If the stop is widened, the ratio weakens. If price reaches near the target before entry, the trade must be skipped. A valid idea can become a bad trade when timing gets late. That is where discipline protects the account. Now watch the behavior. Price moves up from the lower memory. It tries to build distance. But the old box still controls it. Bodies do not expand freely. Pullbacks still appear. Reaction still comes back. The move can pay, but it cannot be treated as a fresh trend. That is why the target stays at June 4th U.S. upper boundary. Take the box seriously. The box gave the entry. The box gives the target. Now trader type matters. An aggressive trader may tighten the stop. The stop becomes smaller. Position size can become larger. Sometimes that works. Price never touches the tight stop. The trade pays faster. But that is not free. A tight stop can be hit by normal reaction. Price can still move toward the target after the stop is hit. The trader was right about direction. But the position is gone. That pain must be respected. A conservative trader gives the structure more room. The stop is not too tight. The position size becomes smaller. The trade survives more noise. But if the wider stop destroys the reward, the conservative answer can become no trade. Here, the structure gives 1.79. So the trade can be studied. But it must be taken at the right line. Now think about trailing. If price reaches the first target and keeps holding, the trader may want more. But the target does not move just because the trader wants more. The market must earn the trail. A practical trailing interval needs about 0.5 risk-reward unit or more. Less than that often becomes noise. If you trail too early, the trade cannot breathe. If you trail too late, the profit gives back too much. When the target moves, the stop must move too. A target that moves without a stop is only hope. But the stop cannot be too tight. If normal reaction touches it, the trail damages the position. If the stop stays too far back, the trail protects nothing. So the stop follows structure, not fear, not greed, not the last green candle. Partial profit can help. If price reaches the first target and reaction gets faster, a conservative trader protects more first. 60% first. 40% left for continuation. If price holds the target and distance keeps growing, an aggressive trader can leave more open. 40% first. 60% for continuation. If the move reaches multiple stages, the same logic continues. A conservative trader can take 50% first, then 30%, then 20%. A balanced trader can take 25% first, then 50%, then 25%. An aggressive trader can take 20% first, then 30%, then 50%. But the percentage does not create the edge. The edge comes from the line. The edge comes from June 4th U.S. lower boundary holding. The edge comes from a target that pays. June 7th, Asia gives the first message. The box expands. Price bounces. But the old June 4th U.S. memory still controls the trade. The long works only when lower memory holds. Price reaches. It reacts. It holds. Then the trade begins. Price compresses again. But compression does not give freedom. The session forms inside old upper memory. Before reading June 8th U.S. session, keep the higher time frame field visible. The weekly chart is still active. April 1st weekly basis box lower boundary. March 1st weekly basis box lower boundary. February 1st weekly basis box lower boundary. Weekly 0.33. Weekly 0.25. February 5th key low. The falling trend line. The rising trend line. These areas still shape the 1-hour chart. The market already bounced from lower pressure. But a bounce does not erase the larger field. A recovery can move up. Then it can stall. Then it can return lower. That is why we do not chase the middle. Now look at June 8th U.S. session. June 8th U.S. session forms between June 4th U.S. session upper boundary and June 4th U.S. session midpoint. It compresses by about 50%. It overlaps there. That matters. June 7th Asia had expansion. June 8th U.S. has compression. The market moves from wide range into tighter decision. A compressed session box can make the next reaction faster. Price has less room to hide. The upper side becomes more important. The lower side becomes more important. But compression alone is not entry. Price must reach. Price must fail. Price must return. June 8th U.S. session moves inside its own basis box. It continues inside that compressed structure. It tests the upper side. It tests the lower side. It does not create clean freedom. The market rotates. Bodies shrink. Wicks grow. Reaction comes sooner. Continuation fails earlier. That is the pressure. Now the short setup appears. Short entry line. June 8th, U.S. session upper boundary. Stop loss line. Weekly 0.33 area. Take profit line. June 4th U.S. session lower boundary. Risk-reward ratio. 1.86. The entry sits at June 8th U.S. session upper boundary. Why there? Because the session forms compressed under higher pressure. The upper boundary becomes the recovery test. If price reaches the upper boundary and stays above it, the short loses pressure. If price reaches the upper boundary and cannot hold, the bounce has failed. That failed hold becomes the short. The short does not start at the lower side. It starts where buyers fail to keep the upper side. That is the difference. Do not sell after price has already fallen through the box. That can be late. Sell only when the upper test fails and the risk still pays. Price reaches the upper boundary. It reacts. It cannot stay. Distance does not open upward. Reaction returns faster. Now the short has structure. The stop sits at weekly 0.33. That stop is important. Weekly 0.33 is not just a number. It is a higher time frame pressure line. If price recovers above that area and holds, the short idea changes. The 1-hour failure is no longer clean. The higher time frame pressure is being reclaimed. So the stop must respect that line. A stop inside the small box may improve the ratio, but it may not protect the real idea. If price pushes above the compressed box and attacks weekly 0.33, the short is already under pressure. If price holds there, the short should not remain open. So the stop belongs near weekly 0.33. It defines the failure. The target sits at June 4th U.S. session lower boundary. Why there? Because the trade is still working inside June 4th U.S. memory. The same old box controls both sessions. June 7th long used June 4th U.S. lower to upper. June 8th short uses June 8th upper failure toward June 4th U.S. lower. The old lower boundary becomes the target. That is why the target is not chosen emotionally. It is the next meaningful working memory. If price fails near the upper compressed zone, the return target is the old June 4th U.S. lower boundary. Risk-reward ratio is 1.86. That is above the minimum filter. But it is not large enough for sloppy execution. Entry must be near the actual upper boundary. Stop must not be widened without reason. Target must not be moved lower before price earns distance. If the trader enters late, the ratio weakens. If the trader chases after the first red candle, the target gets too close. If the trader widens the stop above weekly 0.33, the trade can lose quality. So execution must be tight but not fragile. That is the hard part. Tight execution is not the same as a tight stop. Tight execution means the entry is taken near the real line. The stop still belongs where the idea fails. Now compare the long and short. June 7th Asia gave a long from old lower memory. Risk-reward ratio, 1.79. June 8th US gives a short from compressed upper memory. Risk-reward ratio, 1.86. Both trades are not extreme. Both trades require discipline. Both trades depend on the same old June 4th US box. That is the lesson. The market is not giving a clean trend. It is giving rotation inside old memory. Long from lower memory. Short from upper failure. The trader must not get married to direction. The trader must read the boundary. Now trader type again. An aggressive trader may tighten the stop below weekly 0.33. The ratio improves. The position size can increase. Sometimes that works. Price never reaches the tighter stop. The short pays. But compressed boxes can whip. A wick can reach. A reaction can touch. Then price can still drop. The idea was right. The position is gone. A conservative trader gives the structure room. The stop respects weekly 0.33. The position size becomes smaller. The trade survives more noise. But if the wider stop makes the ratio too weak, no trade becomes the conservative answer. Here the trade still has 1.86. So it can be considered. But only if entry is clean. Now management. If price moves toward June 4th US lower boundary, protect. Do not assume continuation. The market is still inside a higher time frame field. The same lower boundary that worked as long entry before can create reaction again. If price reaches the target and stalls, take the result. If price breaks through and holds lower, only then can trailing be considered. The trail must be earned. A practical trailing interval needs about 0.5 risk-reward unit or more. When the target moves, the stop must move too. A target that moves without a stop is only hope. But the stop must follow structure. Not the last red candle, not the feeling that the trade should keep going. If price cannot keep distance, protect more. If price keeps distance, let the remaining position work. Partial profit can help. A conservative trader can take 60% first and leave 40%. An aggressive trader can take 40% first and leave 60%. For multiple stages, a conservative trader can take 50%, then 30%, then 20%. A balanced trader can take 25%, then 50%, then 25%. An aggressive trader can take 20%, then 30%, then 50%. But the split does not matter if the entry is wrong. The structure comes first. Now, the final view. June 8th US forms compressed between June 4th US upper boundary and midpoint. Price tests both sides. It cannot leave cleanly. The short forms at June 8th US upper boundary. The stop sits at weekly 0.33. The target sits at June 4th US lower boundary. Risk-reward ratio, 1.86. The setup is not a prediction. It is a condition. If the upper side holds, no short. If the upper side fails and price returns lower, the short becomes active. If the entry becomes late, no trade. If the target gets too close, no trade. If the risk-reward breaks, no trade. Today's chart needs the higher time frame. If the movement feels confusing, go back to monthly, weekly, and daily. Especially weekly. The 1-hour chart shows the fight. The weekly chart shows the field. Price reaches. It reacts. It holds or fails. And the trade only happens when the risk deserves the reward.